Welcome to the MBA Diaries, where business meets clarity. Accounting may sound intimidating, but it all starts with three golden rules: simple, timeless, and powerful. In this video, we are going to break down the golden rules of accounting in a way that's easy to remember and even easier to apply, with real life examples you won't forget. Whether you're a commerce beginner or just brushing up your basics, this video sets the foundation right. So, get ready, stay focused, and remember: learn smart, think sharp, and grow continuously. With this, let's start with our video. Today, we are starting with one of the most important and basic concepts in the world of accounting: the golden rules of accounting. Accounting is the language of business, but like any language, it has grammar, and these golden rules, they are that grammar. If you get them right, you can record any transaction with confidence. Now, let's begin with the basics. What are the golden rules? In accounting, we classify accounts into three main types: personal account, real accounts, and nominal accounts. Now, each of these accounts have their own rule. That is, for personal account, the golden rule is debit the receiver, credit the giver. Now, let's say you pay 1000 rupees to your friend Aman from your business account. Now, Aman is receiving money, so we debit Aman's account. You are giving the money, so we credit cash or bank. In short, whoever receives something from the business is debited. Whoever gives something to the business is credited. That was personal account. That is, debit the receiver, credit the giver. The receiver was Aman here, and we reduced our cash balance, so we credit cash or bank account. Now, next up is real account. Now, real accounts golden rule is debit what comes in, credit what goes out. Now, let's understand this simply with an example. Now, let's say your business buys a machine for 50,000 rupees. The machine is coming into your business, so we debit the machinery account. As the golden rule says, debit what comes in, credit what goes out. So, the machine is coming in, so we will debit it. And the cash is going out, so we will credit the cash account. Simple logic. Track what enters and exits your business in terms of physical or financial assets. Now, lastly, the nominal account. Nominal account's golden rule says debit all expenses and losses, credit all incomes and gains. So basically, if you're incurring a loss or you're spending something, that will be debited. Whereas if you're gaining something, if you're earning income, then it will be credited into your account. Just like when you receive money in your bank account, it is credited. Similarly, if you're paying someone, it is debited from your account. Let's hear this out with the use of an example. That is, if you pay rent of 10,000 rupees, that is an expense. So you will debit the rent account. Now, if your business earns interest of 2000 rupees, that's income. So you credit the interest income account. In short, expenses and losses are debited. Incomes and profits are credited. So basically, personal accounts golden rule is debit the receiver, credit the giver. Real accounts golden rule is debit what comes in, credit what goes out. And lastly, nominal accounts golden rule is debit expenses and losses, credit incomes and gains. So these three simple rules are the foundation of double entry bookkeeping. Once you master them, you've already won half the battle. I hope you understood the accounting principles, golden rules of accounting, and don't forget to like, share, comment, subscribe. Thank you.